For many successful professionals and business owners, do-it-yourself investing is a point of pride. You're smart, you're capable, and you've managed well to get to this point. But that success creates complexity. The when for hiring an advisor isn't a magic number. It's an inflection point when the complexity of your assets, taxes, and legacy goals exceed the time and specialized knowledge you have available. This isn't about intelligence, it's about specialization. You've proven that you're an expert in your field. The question now is whether you also have the time and desire to become a part-time expert in tax law, estate planning, and global markets. If your financial life includes any of the following facts, you may have crossed the threshold where hiring an advisor now makes sense. The first sign is that your tax return no longer resembles a simple filing. You've graduated from a straightforward W-2 to a mix of complex equity and business income. It's time to seek specialized competence when your balance sheets includes executive compensation, such as managing a schedule of restricted stock units, incentive stock options, non-qualified stock options, or employee stock purchase plans, each with different tax treatments and grant dates. Concentrated equity. More than 10 to 15% of your net worth is tied up in a single company stock, or worse yet, the stock is in the company that you work for or own. This creates a significant, undiversified risk. Business ownership. You're dealing with K-1 distributions, buy-sell agreements, succession planning, or structuring a tax-efficient exit. Complex tax liabilities. Are you subject to the alternative minimum tax, pay state taxes in multiple states, or are you looking for advanced, multi-year tax optimization strategies and not just minimizing a single year's tax bill? Alternative investments. You're vetting private equity, venture capital, or real estate syndications and need to understand their risks, tax implications, and role in your portfolio. These aren't DIY problems. They are sophisticated, legal, and tax strategies. This is also where an advisor's philosophy is critical. When solving these problems, is their incentive a cost-aware, suitable solution for you? Or is it to sell you a specific high-fee product, like complex insurance vehicles or a proprietary fund, that their firm later incentivizes them? A fiduciary is legally bound to the first approach. A broker-dealer is not. This is a straightforward mathematical calculation of convenience. Your most valuable asset is no longer the investment portfolio. It's your time and ability to earn in your own profession or business. Let's calculate the hours you spend on investment research, analysis, and rebalancing your accounts, coordinating phone calls and emails between your tax preparer and your estate attorney, tracking cost basis, managing cash flow, and reviewing insurance policies, and understanding and executing your equity compensation. Now, multiply those hours by your effective hourly rate. In most cases, the cost of the time you spend doing this work often exceeds the fee of delegating it. Consider comparing your hourly value with an advisor's fee to see if delegation makes sense for you. But this calculation only works if you can trust the person you're delegating it to. True convenience isn't just offloading tasks. It's offloading the mental energy and worry. That's only possible when you know your advisor is a fiduciary, legally bound to act 100% in your best interest. If you have to spend mental energy wondering if their advice is conflicted by commission, you haven't truly bought back your time. This is the most powerful sign because it's not about lack of intelligence. It's about human nature. The greatest risk to your portfolio isn't a bad market. It's your own behavior in a bad market. The most famous case study in this is Peter Lynch's Fidelity Magellan Fund. From 1977 to 1990, Lynch was arguably one of the greatest fund managers, posting an astounding 29% average annual return. It would seem that anyone invested in that fund would have become incredibly wealthy, but they didn't. A study by Fidelity on its own fund revealed a shocking fact. The average investor in the Magellan Fund actually lost money during that same period. How is this possible? The data shows a classic example of what is commonly referred to as the behavior gap. Investors, excited by the stellar returns, would buy into the fund after a period of strong performance. Then, when the fund hit an inevitable rough patch or a market correction, they would panic and sell at a low point. They were chasing performance instead of practicing discipline. This is the coaching component, and it's a crucial philosophical test of an advisor. Is your advisor paid to help you stick to a plan, or are they paid by transaction? A fiduciary's incentive is 100% aligned with your long-term success. A non-fiduciary advisor's incentive may be to encourage you to make a move, even if it's the wrong one, because trading is a component of how they get paid. If your entire financial strategy exists primarily in your head or on a personal spreadsheet, you have a single point of failure risk. This is the continuity component. Your plan lacks continuity if your spouse is not actively involved in the financial plan or prepared to take over if you are unable to continue. Your estate plan is a set of what if I die documents rather than a how-to guide for your family. Your children's engagement with the family's wealth is undefined, risking conflict, mismanagement, and misunderstanding. Lastly, you have no formal plan to effectively transfer assets, minimize estate taxes, or align your wealth with your philanthropic goals. History is filled with case studies of significant wealth evaporating in 2 to 3 generations. This is commonly referred to as a short sleeves to shirt sleeves phenomenon. The failure is almost always one of continuity. As you build this structure, be mindful of how it's being built. Is the plan centered around objective, flexible strategies, or is it built around high commission products with long lockup periods that may or may not be the most efficient way to achieve your goals? A fiduciary's incentive is to design the best plan for your needs, one that can pivot as new information is presented. Hiring an advisor is not an admission of failure. It's a decision of practicality to delegate a specialized function so you can focus on your highest value work. You want to find a professional partner whose incentives 100% align with yours. This frees you up to focus on what you do best: building your business, excelling in your career, and living your life. If you've happened to check the box on any of these points, it's likely time for us to have a conversation.